So friends and colleagues, welcome to this seminar on survival of outward investments from India and China. Is there a north-south divide? And there is a very interesting paper which Suma has written with two of her co-authors, and she is basically trying to see whether there is any pattern between the investments that emerging markets or in emerging countries like China and India or India and China are making across the world. So is there a pattern between those investments that are made in the northern countries and those that are made in southern countries? And if there are those, so what are those patterns? So basically, I mean, I understood that is what Suma is trying to say in that paper or find in that paper. And we will, of course, hear from the horse's mouth, as they say, uh, the author's mouth, as they say. And then we have three very eminent panelists. And by the way, I didn't introduce Suma because Suma has been on this forum of ISID for some times, a number of times, I think. And currently, she is a visiting professor at ISID, and her original position is at Essex Business School, where she is a professor of technology strategy, if I remember it correctly. And then, so after Suma has shared her presentation on that research that she has done, we have three very eminent panelists to take her to task, so to say. One is Dr. Andrea Goldstein, an old friend who is about to join us. He's sitting in Paris, in OECD headquarters, where he is a senior economist. And he has been a former colleague also for some time. He was part of UNSCAP as well. And then Dr. Alka Chadha, my former colleague at RIS, long time ago. Why I thought of inviting her to be part of this panel is the fact that we jointly wrote a paper long time ago on China-India outward FDI in steel industry. And so much into the past that I have forgotten what we wrote. I am sure she remembers that, but I don't. And then the third panelist is Reggie Joseph, whom you all very well know, a colleague at ISID. He's an associate professor and works off and on outward FDI, among many other things. So with that, I want to ask Suma to go on with her presentation. And I'm sure Andrea would have joined any moment from now. Yes, go ahead, Suma.
Thanks, Nagesh, and thank you for giving me this opportunity to present the paper. This paper has been a long time in the making. I think the first version of the draft that you have seen was written last year in January, but we had been working on this paper for 2 years before. So just to, I mean, it's not to say that I'm terribly slow or anything, but it does take some time to craft a paper, and I just wanted to sort of put that out there. This paper is done together with Abu Bakr Saeed and Saad Balok. So Abu Saeed was my student at Brunel, my first PhD student, in fact. And, after his PhD was on the structure of financing and financial liberalization and its effect on outward FDI from India and China. And somehow we kept in touch, and he proposed to do this work with his student, that's Saad Balok, who I haven't actually met, but I've worked with. And so this paper is the result of our joint efforts. The motivation for this paper is from this following fact, which you may or may not agree. But I have often thought that in the mid-1990s, Chinese and Indian firms were a bit like the Jovanovic entrepreneurs in the international arena. So for those of you who haven't met Jovanovic's work, Jovanovic wrote about entrepreneurship, and he has a very famous paper called Selection and Industry Evolution, where he argues that actually when new entrepreneurs arrive to a competitive arena, they don't really know their true productivity. So they discover it as they start producing and find out who's better in the market than them, who's worse in the market. So the first estimate of their productivity is a guess, but their true productivity and where they are really good at, they only realize over time. It's also an idea which is there in works like Roderick and Hausman, where they talk about entrepreneurship as self-discovery. So my thinking about this started in the following way, that, if Indian and Chinese firms were pretty new to the international market, they were a bit like those Jovanovic entrepreneurs who didn't really know where their actual advantage lay. So they made several investments to exploit and augment their assets without knowing exactly which ventures would be successful. So when you have this kind of a situation where you have a lot of investment options, you have some idea about the payoff, but there's also lots of uncertainties surrounding it, then usually finance guys use what they call a real options lens. And that's what we try to do in this paper. We try to use a real options lens to develop the theoretical arguments for why some investments survived and why some didn't. And of course, the empirical counterpart of that sort of thinking from us is the use of survival analysis to understand the factors associated with those investments that were long-lived, that didn't die out or didn't exit. Now, you won't find this in the paper, but I just thought it's helpful to put it out there so you know why I'm thinking like this and not in another way. So real options thinking requires specification of risks and rewards. The premise on which we develop the propositions in this paper is that the investments in northern locations and investment in southern locations offered different risk reward bundles and different risk mitigating factors. So you can think of them as an option of investment that comes with different rewards attached to it and different kinds of risks. And also there are different ways you can mitigate those risks. So in the presence of risks and rewards, firms can take three types of actions. They can either stay and hold their investment, which we call survival. They can expand. They can put more investment in an area. So this is the growth of the investment. Or they can simply exit. They can say, well, we don't want to keep this. We want to cut our losses. And in this case, you have divestment. So using this real option lens, we can actually study all three stages, though in this paper, we have concentrated much more on survival, which is, if you like, a mirror image of the exit decision. So so what are the rewards of investment and how are they different between North and South? So the first thing we have to know is that we don't actually observe the actual rewards, but we know that long-term rewards are related to firm-specific competitive advantages. This is a very well-established tenet in the IB literature. But FSAs, firm-specific competitive advantages, are a relative concept, right? I mean, you can have any advantage, but it's only good if your competitors don't have it. So it depends upon competitors' FSA as well. So what is the true FSA you enjoy depends on how good are your competitors. And here we can speculate that, I mean, I'm cutting a lot of the motivation short because, I have to finish in half an hour. Here we speculate for various reasons that Indian and Chinese firms probably had stronger FSA relative to host firms in southern rather than northern countries. So this is intuitively obvious. It's also something that has been reflected in previous work on third world multinationals done by the late Sanjay Lal. And it's understood. You can instinctively understand it. You don't need a lot of elaboration. And so our first hypothesis is that EMN is in general, and we were testing on an Indian and Chinese firm sample, but these are more likely to survive in southern locations as compared to the north due to the stronger FSAs relative to their local competitors in those locations, in those southern locations. Next, we go to the types of risks, because remember that the real options lens needs you to specify both of these very clearly. So here, when you talk about risks, it's customary to distinguish between endogenous risk and exogenous risk. So endogenous risk is the risk of production and operating in an environment that's unequal between firms, and therefore which firms can mitigate through their actions. So another way of thinking about it is those kind of risks that affect some firms more than others. For example, an unfamiliar business environment. Immediately you can see that the unfamiliar business environment is a handicap for foreign firms, but probably not for host country firms in that location. And probably also not for firms who've been operating in that environment for a long time. Okay, so this is an example of an endogenous risk. Institutional distance is another example of endogenous risk. So firms that are institutionally closer face less of a disadvantage than firms that are very distant institutionally from the firms that operate in locations where the institutions are very different from that they find in their home environment. In contrast to exogenous risks, you have endogenous risks, you have exogenous risks. These are those parameters which affect firms' revenue streams without investing, that affect with investing firms, which investing firms' actions cannot influence, or these are risks that influence all firms equally. So single firm actions cannot actually alter this risk. So examples of this are the financial crisis, COVID-19, many other unforeseen macro events, petroleum price hikes, and so on. So these are all examples of exogenous risks. So what does that have to do with northern and southern locations? So because of institutional similarity, we think that EMNEs suffer a smaller amount of endogenous risks in southern locations. So their survival in northern locations, where the institutions are more distant from what they find in their home country, are likely to adversely affect those multinational survival. But in southern locations where the institutions are pretty similar to what they find in their home countries, they may be less affected. Their survival may be less affected by it. This, by the way, is not, there's a lot of literature now that suggests that institutional similarity affects several emerging market multinational outcomes, such as how successful they are at mergers and acquisitions, what is their post-merger performance, and so on. So it's not a terribly new idea. The second hypothesis is that exogenous risks will, of course, adversely affect survival in both locations, because by definitions, these are the risks that firms can do little about. If you have the staying power to sort of see it through, so if you have deep pockets, you might, but most likely firms will try to cut their losses. So that's that's the way the risk reward bundles are a bit different, because in the South, there's better reward and in some ways a lower risk, in some ways a higher risk, because there's more sort of political risk in southern countries. But in northern countries, there's a higher endogenous risk and there's exogenous risk, which is common to both locations. Then we say that, well, what can mitigate those endogenous risks? And from my previous studies on software and pharmaceuticals, anecdotal evidence suggests that the diaspora play a big role. So in the case of software and pharmaceuticals, the diaspora were important as gatekeepers in the new environment. So for example, Indian software firms investing in the US gained through the reputation of Indians who had been successful in Silicon Valley. Those Indians often acted as gatekeepers for venture capital funds. So there is this whole literature, especially based on Irish, Indian, and Israeli software firms, which suggests the diaspora had very important roles to play in allowing them to enter new markets. In a more recent paper, Saul Estrin finds that emerging multinational investment is attracted to markets with large diaspora. So this is something that he finds different between emerging market multinationals and developed multinationals, that EM&E investment seems to be attracted to markets with a large diaspora. And his argument is that diaspora can often act as a beachhead to enter new markets. So they provide ready markets and a willingness to try products from their country of origin. And these diaspora are also more common in southern locations. Again, this is a factor that was highlighted in early studies of third world multinationals. So we have two types of effects due to the diaspora. One is that they provide a ready market for goods. And the second is that they help businesses navigate difficulties in the business environment. So in a way, they mitigate endogenous risk. So this is how we conceive of it, that they can alleviate the effects of a different business environment, and they can alleviate the effect of country-specific political and other risks. And this is pretty important in the South. We found that the diaspora is much larger as a share of population in the South than in the North, even though in terms of absolute numbers, probably there are more, the absolute number of diaspora are much higher in the northern countries. So it's a sort of relative size effect that we try to capture. So that leads to our next two hypotheses, which is that immigrant diaspora have a stronger positive effect on EM&E survival in the South as compared to North due to the larger ready markets in the South. And that's also, just a restatement of the Estrin finding in a way. And that immigrant diaspora provides a source of learning about how to overcome endogenous risks and act as gatekeepers to foreign institutions. So a larger diaspora, ceteris paribus, would have a stronger effect, positive effect on survival. So armed with this so I hope you can see the link between real options, how we are thinking about Indian and Chinese investments, and how we develop these hypotheses. I would have loved to spend more time on it, but can't. I move over to the empirical methodology. So the empirical methodology that I employ is to look at a data set of Indian and Chinese firms who have subsidiaries in different locations, and try to estimate survival models. So what survival models do is that they look at the duration of investment. So they say that, firm enters, or it may be censored, you don't see when it you may or may not see all the entry and exit, but starting from a cohort, you can see that some firms drop out and others don't. So we try to estimate what's the duration of survival and what are the other factors that affect it. In particular, what is important is the so-called hazard rate, which shows if you survive till T, what's the probability that you'll fail in T+1 or T plus delta T? Okay, and that is estimated through this exponential. So there's the baseline hazard, and then there is an exponential, which is covariates, which is a set of explanatory factors, beta prime x, with unknown coefficients. So because this is an exponent, so when you work out, what is the actual effect, there's a difference whether the coefficient is greater than 1 or minus 1. So if it is a negative coefficient, then basically you're contracting. So it sort of predicts, so this affects the computation of probabilities. I can go into it in the discussion time, but the thing to remember is that it is not a simple linear regression. It's a non-linear regression where we are trying to measure duration, in particular the slope of the duration function, and you're trying to interpret negative coefficients as those coefficients where the hazard decreases and the corresponding probability of survival increases. So these are the way that we usually use survival functions. They are more used in entry-exit literature, and this is a kind of study of exit of subsidiaries. So the data we collect are from Orbis and Osiris. So these are, I don't know how many of you are familiar with these databases, but let me spend a little bit of time explaining it so that, if you find it useful, you might want to subscribe to this database. So Orbis is a database which reports on the unconsolidated accounts of parents and subsidiaries. It's not a very complete unconsolidated account because firms in some countries are required to file unconsolidated accounts. And in some countries, they can file consolidated accounts, which means that they don't have to specify what part of their income came from which subsidiary. And this has been used for a lot of work on foreign firms by a number of authors in recent years. We start, however, with Osiris, which is a database of publicly held firms. And in this database, you can take out, let's say, firms of Indian and Chinese origin. And it'll give you the structure, the subsidiary structure for each firm. So we take the subsidiary structure and match it to Orbis in order to extract the company specific data. So it's not a trivial exercise. I think we spent about 4 to 5 weeks initially, then we spent again another 2 weeks. So depending on what kinds of definitions you employ, the things can change, how many firms you have can change. And there's a lot of missing values. So cleaning the data takes a lot of time. Anyway, after this whole exercise, which mostly was done by Saad, we managed to collect data on all non-financial Chinese and Indian foreign firms, firms with foreign subsidiaries, which are also publicly listed. So we had data on 176 Indian and 218 Chinese enterprises. And this resulted in information on 418 Chinese and 329 Indian subsidiaries. Then, after having collected this data, we had to decide which subsidiary should we consider divested. And we took 3 criteria: that the subsidiary is reported as not active on Orbis, or the second criteria was there was no record available for 5 consecutive years following the last entry, or it was mentioned in the parent annual reports that we have divested the subsidiary, because parent company annual reports sometimes do mention which subsidiaries they have closed down. So based on these criteria, from those 700 plus subsidiaries, we found that 241 subsidiaries had been divested, with an overall survival rate of 67.7%. That's just how many subsidiaries survived. So that is the total subsidiaries minus the ones divested upon the total subsidiaries. And so 67.7% in all were divested, were surviving. So, about a third were divested. And of these 241 subsidiaries, 179 subsidiaries were divested from northern locations and 62 subsidiaries from southern locations. So in the paper, we describe what we mean by north and south, because it is a terminology used in the trade literature. And I think, because of ISID's work on international trade and bilateral relations, you might be familiar with it. But northern locations correspond to a large extent with high income economies, and southern locations with developing or emerging economy, developing and emerging economies. So here is a kind of quick picture of what is happening in the data. I mean, this is just, I've not fitted any curves or anything, but you can clearly see that the financial crisis has a big effect on what's happening. And then that is confirmed when you just do some simple cross tabs where we look at how many unprofitable firms stayed. So in 2005 to 2009, which is before the crisis, many more unprofitable firms were sustainable, especially in the north. But by the time you come to 2010, 2018, this is no longer the case. So the financial crisis has a big impact on this. And also there's no sort of automatic relation between profitability and the state decisions. So you can see that there's a lot of unprofitable firms that are held on to. So this, I think, also justifies the real option framework we follow. So let me, you can find the variables we computed in table 1 in your handout. And then in order to measure firm specific advantages, we took 3 different kinds of measures. So we took a measure of the R&D intensity, so R&D expenditures divided by total revenues. And then we computed something which we call absorptive capacity leader. So if the focal firm had a R&D intensity higher than the R&D intensity on average of local firms. So supposing you're located in Tanzania, then this would be the R&D intensity of Tanzania. So like, we can generate like variability in the data set in this way. So it takes value 1 if you have higher than the average local ratio, and it's 0 if you are lagging behind. So for example, in the UK, Indian firms would probably lag behind in many sectors in this. And so they would have an absorptive capacity variable, but then there'd be the leadership variable would be 0, and so on. So we do the same for profitability measured as earnings before tax. And then we do the same for labor productivity. To measure endogenous risk, we use 2 country-specific indicators. The institutional distance indicator is the Kaufman index, and the country risk is the rule of law indicator. And we just follow actually Buckley's paper. He quantifies endogenous risk in this way. And we measure exogenous risk, of course, by the financial crisis, which is the dummy variable, but also we create measures of demand risk, production cost risk, exchange rate risk. And what all of these do is they try to measure in some way the volatility of the time series of those macro variables. We measure the immigrant diaspora by the ratio of the share of immigrants from China and India residing in the host country to the total population of the host country. So there's a bunch of control variables which I have not put on a slide, but you can see on table 1. And those control variables are really variables that have been used in other studies on divestment. So we just include everything because we don't want to have any omitted variables that people have found important and we have not taken into account. So our findings, I'd ask you to refer to table 2 in the handout. So the descriptive statistics show us that in terms of the relative FSA, however we measure it, whether we measure it by profitability, absorptive capacity, or labor productivity, the Chinese and Indian subsidiary have higher relative FSA in southern locations when compared to northern locations. We find that the level of exogenous risk is higher in the north, but endogenous risk in the form of country risk is higher in southern locations. So the exogenous risk includes the financial crisis, which hit northern locations harder than southern locations. Diaspora as a percentage of population, as I already said, is smaller in the north when compared to southern locations, even though absolute numbers are probably bigger in the north. So the second set of findings relate to the hazard models themselves. So the coefficients in table 4 tell you the direction of effect. But the implied risks or the probabilities are given by the hazard rates, which are reported in table 6. So in table 6, we take the exponential and we compute it. And that's what that table is about. So where there's a negative value, you subtract from 1. Where there's a positive value, also you subtract from 1. And So There's a table 5 which reports on homogeneity tests. So this is to see if we are right to pool the Indian and Chinese data together. Are we right to separate the northern data from the southern data, or is it just sampling variation? And so the reassuring result from from that table is that data on Indian and Chinese firms may be pooled, but data on north and south locations cannot be pooled. So our strategy of generalizing on the basis of Chinese and Indian firms is sort of justified. When we look at the hazard rates itself, I'm just giving you now some headline figures so that you can understand what's going on in those tables. So we find that R&D spending and labor productivity play no role in explaining exits in the north, but they do reduce the probability of exit in the south by 38% and 7% respectively. Having a higher profitability than host country firms, so being a leader in profitability, decreases the probability of exit by 30% in the north and by 55% in the south. Endogenous risk increases the hazard of exit in the north by 107% and 19%. So you remember we have two measures of endogenous risk. So we didn't combine them into one variable. So that's the country risk is 107% and 19. Exogenous risk increases the hazard of exit in both the north and the south. And the real culprit here is the financial crisis, which was a very exogenous source of risk. And again, we find for the effects of diaspora on survival, the existence of a home country diaspora alone reduces the likelihood of exit by 44%. But when we look at the coefficient on the cross variable, that is diaspora multiplied by the two sources of endogenous risk, then you find reduced exit due to country, that it reduces exit due to country risk by 22% and due to institutional distance by a smaller 5%. We also found, consistent with many other studies, that parent experience of a region increases the probability of survival. So in sum, I think all the three main, the main hypotheses that we had conjectured, we find support in the data for it. So what are our key contributions? I think first of all, we make two theoretical contributions. First, we add to the understanding of the location bounded nature of EMNC firm specific advantages. So people have written about how the firm specific advantages enjoyed by Chinese and Indian firms are very specific. It's to do with operating in an adverse environment. It is to do with low labor costs and so on. But there's always been, I think Professor Rugman was always very skeptical about it, because he felt that, well, if there are those kind of advantages, they can be imitated away by more able firms. And so in a way, we extend this idea that this FSA is location bounded, not only because of where it comes from, but also where it's deployed. So what your competitors do is really important. And so the domestic competition really, it also binds to what extent, it also puts a bound on what you can do with the FSA. The second thing is we examine two boundary conditions that influence survival of Chinese and Indian outward investments across the North and South. One is the immigrant diaspora, and the other is the experience of institutionally similar markets. And we show that these can actually explain survival. Our empirical contributions are that we show that there's a North-South divide in the survival of Chinese and Indian outward investments. And to the best of our knowledge, this has not really been discussed or computed in the literature. We also show that this is a higher survival because of stronger FSAs in the South, and that the stronger FSAs are useful in mitigating endogenous risks in the South, and of course, the role of the diaspora. So empirically, I think I have not seen that many studies that address the survival of EMNEs. So we are contributing to a very small literature in that area. And of course, survival has not much to do with performance, especially if we take this real options view. And so, I think that's also one of the empirical contributions of the paper. I'm sorry I've taken more, 7 minutes more than half an hour, but I hope that's okay, Nagesh. I'll stop here and take questions.
Thank you, Suma, for what is a rather, sort of rigorous paper, and very often, can you hear me?
Yeah, I hear.
Yeah. So this kind of technical papers are very hard to be presented in a very cogent manner, but you have achieved that distinction. So I have a couple of questions in my mind, but I will hold them on till we hear our panelists. And I understand Andrea is on board. He joined a few minutes later, but I hope he was able to capture or gather much of the presentation. But in any case, he had the opportunity to look at the paper, I suppose. So, Andrea, shall we go with you, or you want to come a little later if you need a little more time? Because he's facing some technical difficulties. So, Alka, can we begin with you?
Yes.
You have heard the presentation from Suma, and which makes a number of theoretical and empirical contributions. So over to you on what you thought about it and how she could go further. Yeah.
Thank you, sir. And, thank you, Suma, for a wonderful presentation. A topic very close to my heart as well, because we worked on exactly the same thing, India and China and OFDI, though it was in a specific area. So it's something that's really close to my heart. So let me begin by the title. Is there a North-South divide? Now, if you see the figure that you presented, we see that survival is falling for both North and South. So is there a divide, or is there something that's impacting both the regions? We are not seeing that North is falling and the South is rising. We are finding a fall in survival for both regions, number one. Number two, if you look at the cross table that you presented, so the total number of firms that exit in the North is 179. And the total number of firms given is 1298. So if you just do a proportion, which comes to 13%. And the similar exercise for the South, 62 exit firms divided by total firms 445. It's exactly 13%. 13.79, 13.93. So if you see the percentage, they're exactly the same. Also, the figure shows both are falling.
Yeah.
So my question or whatever my concern is that instead of looking for a North-South divide, I think there is something that's impacting the survival of both the regions that needs to be looked at. Now, I think in the paper you have pointed out somewhere that it's survival is not rising, it's mentioned there. Maybe due to slowdown in globalization and financial crisis, it has impacted both the regions. Slowdown in financial crisis, yeah, I can take that. Slowdown in globalization is what I'm thinking. Is it slowdown in globalization, or is it too much globalization that's happening? The point I'm trying to raise is that these days we are in the world of Industrial Revolution 4.0, where there's deindustrialization, there's automation, there's global value chains, there are global supply chains. You need not be physically present in one country to be able to sell your products. The other thing that I want to point is that if we see from global value chains perspective, the other thing that's happening is servicification of firms, or also called servitization. where more and more services are being used in manufactured products. So what we are selling is not goods or services like it used to be. What we are selling is solutions. Everything is blurred now. There is no manufacturing services. Both are conjoined. And in that situation, I think the hypothesis should be, I think hypothesis 4 probably is there not South divide, but is there work from home? Can you be in your home country and still do all the work instead of physically locating to a new country? It was already in the making. This unbundling of services had already started before the pandemic hit us. It just gave us the shove towards it. During the lockdown, everybody was at home, but the work went on. That's the point. I think the fall in survival in both north and the southern region shows that there is something bigger that's happening. And that is probably servitization, IT, unbundling, automation, where you don't need a factory to produce things anymore, or very limited. And anybody would know that if you want to make profits, you just go and cut costs. So if there is no rent to be paid in an OECD country, why would I, if I can do it without that? Okay, that's one thing. The other thing I think about the diaspora, it's a valid point, but I think there's the other side to it as well, because while the diaspora might be supportive of what goes on from home countries, but in the case of the world we are living in today, where there could be a US-China trade war, there could be a China-Australia trade war, it will be citizens versus diaspora. Like if there is an attack on the border and Indians of their own volition stop buying Chinese products, even if the Chinese diaspora in India buys, the citizens stop buying Chinese products, then what? And I think the final, which I just heard now, was about the returns to R&D and labor productivity is higher in the southern region. No effect in the north region, which I think is pretty standard, right? Wherever there are more returns, we are going to invest there. North is already near the frontier. So obviously returns to investments in R&D productivity would be much lower. They're already very highly skilled. They're already having frontier technologies. So the results won't really show up. But in the southern countries where you're far away from the boundary, it's more likely that you'll get a positive return. So, so I don't know. I mean, it's a very good paper, and it got me thinking. And I actually thought about it the whole night. And because I have worked on servicification, we just published a paper on servicification of Indian manufacturing. So that just stuck to me. That could that be the reason? Because that is still fresh in my mind. We just published it in March in Economic Modeling. And then I linked it to what you were saying. So I don't know if that is the reason, but you could explore. I mean, that's all. So thank you so much.
Thank you. Thank you. Very interesting.
Thank you, Alka, for very interesting points. And I'm sure Suma will respond to them at the end. Let me now turn to our friend Andrea, and I think he is now unmuted, so he will be able to address us. So Andrea, before you joined, I already introduced you as very senior economist at OECD in economics department of OECD, and a former colleague and an old-time friend. So welcome to this seminar, and over to you.
Thank you very much, and again, apologies for the problems in connecting, but it's a pleasure to be associated to this event, and thanks, Nagesh, for your nice introduction. And thanks, Suma, for this excellent paper, which I really liked, and I read it. I couldn't follow the first part of your presentation, but it's a very interesting paper. Now, I just have kind of 6 points, but will be pretty short. The first point is a general point, which is on the importance of this paper looking at the investment diaspora, investment and migration nexus, which you may want to somewhere in the beginning of the paper at the outset, maybe also link to the literature, which is slightly thicker, even if it's not a huge on trade and diaspora, which is also very interesting. And some papers, there's a paper in the World Development 2011 in particular, which has been quoted extensively on this, and also there is work by Kruger and others on the importance of having a diaspora in a country in terms of the increase of exports from the south to that country. So this is maybe just to put this in a wider perspective. It's a very important paper from a policy perspective, I think, because I can see at least the 3 reasons for this. The first one is that, as you know better than me, all, at least the countries in the global south, the largest, the BRICS and other countries in the global south, have been supporting the internationalization of their firms, including through investment and including through mergers and acquisitions. So obviously, once there is a policy, when there is a public money involved, obviously it's very important to know what happens to this. So your paper is very useful from that perspective. From the perspective of the countries that receive, in this case, investment from global south and multinationals, it's definitely important because there's been a lot of resistance. And while we see now, right now, people are more concerned with other issues right now in terms of the international global governance and international institutions. But a few years ago, obviously, investment from the South was a very hot topic, including in political conversations and in international negotiations. So again, something that makes your paper very interesting. And the third point is, which you mentioned, I guess, somehow indirectly, is on spillovers and linkages, which of course, once, as you mentioned in the paper, once a company, be it from the south or from the north, but once a foreign company leaves a country, of course, it reduces by definition the amount of spillovers and the quality of the spillovers that can be created. So I think, again, looking at the survival is very important from that point of view. The third point has to do with what I guess is central to your analysis, which is the institutional knowledge that goes with the presence of a diaspora. And there, I guess there is, you talk about experiential knowledge, and which I think is very important now. Obviously, in the case of India and China, which are the other countries you focus on, this comes in very different shapes and shades. Because there's, especially for Indians, as you know, definitely better than me, there's a huge diaspora which has by now reached a very important corporate positions in the US in particular, but also in other countries, especially in Commonwealth countries. And that is something which is even more than institutional knowledge kind of available, which is it's an informal, of course, it's an implicit knowledge, but in the case of this kind of, you talk about informal institutional structures. And of course, again, a country like the US, but also Mauritius and others, in the case of the Indian diaspora, of course, you have such a strong, rich and influential knowledge of the institutional structure. In fact, very often, I think of Mauritius, in particular, the institutional structure is heavily Indian, if you allow me to say that. So it's even more than just something which is kind of available off the shelf, which I think is very important. Fourth point is definitely, which was mentioned already, on whether there is really a difference between the North and South, which I guess still exists, but the point that was made by the previous commentator. A fifth point, which I think is important, which my only suggestion in terms of practical changes to the paper, you talk about affluent Filipinos in California driving the investment by Jollibee. But I think it's if you allow me to use the term in an academic discussion, it's maids rather than affluent Filipinos. And that's, I mean, where you have a huge diaspora. But I can tell you, because I'm right now in Milan, which is where the largest Filipino diaspora in Europe is. And definitely there are nurses and they're caregivers, and they go, and that's why Jollibee has the only European outlet here. So it's not really the affluent, it's more the kind of the home experience that somebody like some firm like Jollibee can bring, which I think is important. Now, the last point I want to make in my remaining minute is on the experience of Italy, which I think is also very interesting, because Italy, you have a longer term longitudinal perspective, because Italian firms did invest a lot at the beginning in the countries which were very far away, especially in Argentina, but also in Brazil, and to a lesser extent in the United States, talking about the late 90s. And I've done some business history on the Italian investment in the United States, in Argentina, looking at the past 150 years. So even if the geographical distance, of course, was huge, and the cost of running operations in these countries was huge, but the presence of a diaspora there meant that that was one of the first destinations after Switzerland and the neighboring countries like Switzerland and France. Many Italian multinationals at the time, very many of the few, but still many, went to Argentina and Brazil, and they did survive because of the psychic distance or institutional distance being lowered by the presence of a diaspora. So in terms of the importance of these variables and for the survival, I think you already spot on, because and obviously the data in your analysis prove that. And I think that kind of course, it's a bit more difficult in the case of India and China, even if in the Indian companies that went international, went global in the 60s and 70s, but obviously, I mean, the longitudinal perspective is a bit more difficult, but definitely there are, I guess, lessons and implications that can be drawn from the experience of other countries. Again, in an era where the global south, the global north was somehow. So I'd be happy to share those two papers.
Thanks, Andrea. Very interesting points.
Thank you, Andrea. Very useful, very interesting points. And sorry for the difficulties you faced in connecting. So let me turn to Reggie, and then we can come back to other questions from the floor and to responses by Suma, if she wants to. So Reggie, I already introduced everyone about Reggie, so you have the floor.
Thank you, Professor Nagesh, for this opportunity to discuss this interesting paper. So my discussion will be focused on the outward FDI from India. So I have prepared a PPT. I will share the same. Next one. The presentation was very crisp and clear, so there is no need for me to summarize the paper. So let me start with the key finding of the paper. The key finding is that the probability of survival is higher in southern countries or the developing countries. And this finding contradicts the findings of a few other studies in this area. And the authors attribute this finding to the framework they have used, which precisely capture the firm's specific advantages. Next one. So this figure shows trends in outward FDI from India to developing countries and developed countries. It shows that over the years, OFDI to developing countries has been declining. So if the chances of survival is higher in developing countries, what explains this trend, the declining trend of outward FDI to developing countries? So the findings of this paper is not providing an answer to this trend. But when it comes to the OFDI to northern countries, the paper explains partially why OFDI to north is rising in spite of higher chances of failure. However, what I feel is that a more convincing explanation is needed. Next one. So a reason for a higher probability of failure in northern countries is that the subsidiaries are not able to develop or acquire relative firm-specific advantages.
On the seminar of
yeah. So these subsidiaries in developed countries, they act more like firms for scouting for best technology, and they find it very tough to compete with domestic firms, and they find it very difficult to survive. So now I would like to see this in the context of OFDI, trends in OFDI to the northern region, the developed countries. If we go in more detail, we see that over the years, the share of services has been gradually increasing, and of manufacturing has been slightly declining over the years. And in services, the investment is led by software sector, and they are not for acquiring technology or scouting for technology. They are for doing business there and taking advantage of their ownerships. The software sector is followed by telecommunications and financial services. So obviously what we see is that these leading sectors of investments, those subsidiaries, they are not for acquiring technology. When we come to the manufacturing sector, it is led by the pharmaceuticals, but I haven't looked into what is the motivation of the OFDI in the pharmaceutical sector. But my understanding from the literature and observing the overall functioning of this sector, what I feel is that they aim for exporting their products. For exporting to developed country markets, a lot of regulatory requirements are to be met. So they basically establish subsidiaries in foreign countries for that purpose. But I'm not saying that they are not doing R&D or they're not acquiring technology from there. But a major objective is to get access to market, to promote the exports. The other sector, within the manufacturing sector, where OFDI is taking place substantially, is the automobile sector. Yes, it is led by Tata Motors and Mahindra, and we can say that yes, they are for acquiring technology, especially design and engineering skills. Now, given this, what I feel is that a more disaggregated level analysis seems to be desirable, especially in the context of changing trends. Generalizing observations without going into sector specificities may sometimes do not tell the true story. Along with capturing the number of failures, you mentioned the number of divestments in the case of both North and South. Looking into who they are, I think this itself will bring out new insights. Next one. So now I would like to focus on the methodology. The focus of this paper has been the environment in the host countries. But similarly, it is possible that some of the policies pursued by the home countries could influence the survival of subsidiaries in foreign countries. If you look at the OFDI policy of India, it has evolved over a period of years. Until 1992, there was a cap on the amount of investment. In 2004, this was linked to the net worth of investor. Initially, it was 100%. It was increased to 400% in 2007. But a special provision was made for the investments from oil sector. So OFDI is generally permitted in incorporated entities in foreign countries. But for oil sector, the investors can invest in incorporated as well as unincorporated entities. And as far as the public sector enterprises are concerned, this ceiling is not applicable. They could invest any amount. If we look at the outward FDI of India, about 1/5 is accounted by the oil sector. So it is likely that the special provision for this sector has contributed in the expansion and survival of investment in foreign countries. So again, what I feel is that there is a need to capture sector specificity. Otherwise, without capturing generalizing observations, may sometimes not give the correct picture. Next one. I have two clarificatory questions. What is the basis for classification of countries into North and South? I'm asking this because there are two references to this in the paper. In one place, it is said that the difference between the two lie in the different stages of industrialization, adoption of technology, and level of institutional development. And in other place, it is mentioned that the North-South distinction is also closely related to IMF distinction between the two, which is based on per capita income, degree of integration into global financial system. So how have you classified the countries into North and South? What criteria you have used? The second question is, what is the rationale for inclusion of Indian OFDI in the study? As I understand, you say that India is a major source of OFDI. China, we can understand. China and Hong Kong, about more than 1/4 of global OFDI is contributed by China along with Hong Kong. But for India, the share is just 1% in 2018. 2018 is the last year of the period of analysis in your study. But in the same year, we find other developing countries like Thailand, Taiwan, Singapore, UAE, Saudi Arabia, which have invested higher amount in foreign countries as compared to India. So it is not clear to me why you have included Indian OFDI in this study. I will stop here. Thank you.
Thank you, Reggie, for adding to the previous two panelists some more points for consideration by Suma. Suma, I think we have crossed our time, but we can continue for some more time. I want to open it up, and there are some questions in the chat box, which I hope you have looked at. And I had a couple of points myself, but I want to just first see if there are any hands being raised from the audience. Any questions from the audience besides those which have been put in the chat box? If none, then let me just add a couple of my own points. One is that this issue of survival in North and the South. The key issue is that the objectives of emerging market MNCs, when they go to South and when they go to the North, they are very different. The objectives, they go to South to support their outward expansion, as Reggie was saying. When they go to North, often it is in search of strategic assets like technology, patents and all that. And so there are many which were made like that. So perhaps when their purpose is technology, when they get access to technology, patents, etc., they fold up investments or subsidiaries, and because their purpose is delivered or done. Maybe that is something you want to keep in mind. The other question which is bugging me is, and there is also a similar question by one of our audiences, Professor Dinesh Awasthi, former Director General of Entrepreneurship Development Institute. What we have argued in some of the papers, including the one I had with Alka a long time ago, is that the Indian and Chinese FDIs or investors were very different. They looked for different things. And so treating them as similar ones, and especially because the Chinese MNEs are generally, state-owned enterprises, and very few private-owned enterprises. The objective function of the two are very different. So keeping them in the same
Mm.
We can hear you.
What has gone wrong? Can you hear me now?
Yeah.
Yes. Okay. So you might wish to split the sample of Chinese and Indian and see if there is any pattern which is different. So these were two very small observations from my side, but there are a few in the chat box which I hope you can see. And then I can turn over to you to respond to any of the points made by our very distinguished panelists and those in the chat box, and respond if you wish to respond to anyone or clarify. Over to you, Suma.
Thank you. Thank you all for so many useful comments and thought-provoking questions. I'm really grateful for them. Let me try to see if I can answer some. I definitely cannot answer all. So the big point from Alka was about, can we talk about a divide when the proportions seem kind of similar and there's a declining trend in both? So the downward trend is a matter, I think it's an artifact of the data. That is, you trace a cohort over time and then some are leaving. So, we cannot observe an increasing trend, put differently. It's always going to be declining. I was not so much interested in the quantities and the numbers as much as the patterns, that the patterns of survival seem different. That is, the beta X that explains in the north is quite different from the one in the south. And that's also what all the homogeneity tests are telling us. In contrast, we did split the sample, Nagesh, and we did do treat China and India as different, but the homogeneity test didn't, they said that they are the same. So this may be that we don't have enough exits. 241 exits out of 700 are not a lot. So maybe there's not enough information for the equation to distinguish. And I think some of that also applies to the comments on, trying to sectorally disaggregate and so on. So one is what we think is happening, and the other is what information can the equation retrieve from the data you've given it. And I don't believe, I wish there were more, but there aren't. And so, based on just the statistical tests, we cannot accept that China and India are different. So I think in the appendix in the paper, we do sort of set out some of those split equations that we did. I think it's table A3 and A4. Anyway, so we did try that. So yeah. Regarding the point about, servitization and also some of Reggie's points about sectoral disaggregation, again, it is possible for sectoral patterns to be different, whereas the overall pattern can be, showing a different direction. So I don't necessarily see this as negating the results, but yes, I can, we've used firm dummies in this paper, which includes, when you use them, you can't also use industry dummies, but we tried to use some industry level factors. But maybe we can do more. I will have a closer look, I'll think about those issues. I think the comments from Andrea were very helpful, and Andrea, thank you so much for them, because I wasn't aware of this literature on Italian diaspora. I did do a study myself on Fiat, and I realized that those diaspora links were very important in them setting up factories and setting up their center in Argentina rather than Brazil. But I wasn't aware of other studies, so thank you for highlighting them. And if you can share them with me, that'll be really interesting.
Suma, Andrea had to leave because he's facing some issues with the Tunisia.
Sure, no problem.
Yeah, there was a coup yesterday in Tunisia.
Oh, is he in Tunisia?
No, he is in Paris, but they were launching a report in Tunisia, and
I see.
that's all. So, so there is a coup.
Yeah. Okay. No problem. So you told me to
he
answer all
apologized to me. Yeah.
Yeah, that's
yeah.
all right. So there are a couple of questions here in the chat box. For example, we are more likely to divest. We can say something about service. The data we have are not so disaggregated that we can check some of these specific causations that you're talking about. I've already answered the question about treatment of India. Hello?
No, go on.
Yeah. I've already answered to some extent Dinesh's question, similar to yours, Nagesh, about India and China being homogeneous. Similarly, some of these are really important, I think, for explaining sectoral trends, but there's really it's very difficult to, so again, I reiterate that 241 exits from a sample of 700 is not, if I increase the level of detail, I'm just taking away degrees of freedom from the equation. So therefore, what I can say is going to be much less valuable because in some way I've forced it on the data. So we tried to operate with what we thought were important variables, very basic level, but I take your point that this might not explain every facet of Indian FDI. I think one last point I'd like to make in response to Reji's comment about why is investment increasing, whereas so you have to understand that this is a study of subsidiary divestments. It is consistent with expansion and investment by the parent. Do you see the point? So a parent can expand investment in one subsidiary, but divest in another. So we are not looking at the parent level here. It's something I want to do, but there are even fewer exits at the parent level. So the maximum number of exits for a parent is 2. Okay, so therefore, that's not such an inconsistency as it seems, because we haven't really, that's not the question we are looking at. We're looking at why is it that some subsidiaries exist, and is there a pattern in this exit which is different from the north and from the south? The question is not whether firms are increasing their investment or they're withdrawing. That would be a wrong inference, because we are really not addressing that question. So think of a parent firm which has 10 subsidiaries, which is very common actually in many of these firms. They have 11 to 13 subsidiaries each. You divested a maximum of 3. Does that stop you? Or can we say that this divested investment is not put more into some other place? We don't know. Okay, so I think you have to be careful to infer something more aggregated from what we're saying. Last point, Nagesh, is about your asset seeking, this point about investments in the north and there being more asset seeking. We do have a dummy capturing that, right? And we find that it does predict greater divestment. And I think, in an earlier version of the paper, we had a long sort of discussion of this, whether northern markets are more liquid investments, because exit is easy in these markets because of the financial development of the economy. So it's like, do I put my savings in a current account or in a house, or in a savings account or in a house? So obviously a savings account might have lower returns, but I can draw on it anytime. So it's a bit like that. But the referees didn't like it, and so we had to take out all that discussion. We left it in as a control because we thought that's what's happening and it was really important, and so we left it in as a control, but we haven't elaborated that argument too much. But my thinking was very similar to yours, that this is in a real options kind of term, we can think of liquidity as another advantage, not just rewards, but rewards and liquidity. Then of course, northern markets have a huge advantage there. So I'm really grateful to you for reading it carefully and giving me all these comments. I've taken some notes, but equally, if you have notes, please share them with me so that, I can take everything on board. I hope I've answered most of the questions. If I haven't, please drop into my room and we can discuss it. Yeah, I think I haven't answered everything Ashish Gosain asked or Dinesh Avasti. Dinesh, the only thing I would say about the support of home governments is that we do find that Chinese firms tend to exit less. So that's clearly something to do with the credit they receive from their home government, or at least that's what we interpreted in the. So part of their go global policy was that we are going to support you even if you make a loss. So anyway, it's an attempt. It's the first time I presented the paper. So thank you for listening and thank you for giving these thoughtful comments. I will take them away and think about it. Thank you very much.
Thank you, Suma. So I think the discussion, the presentation was good and the discussion was also very rich. I'm sure we can, expect a much better paper from you on the basis of these comments and other comments that you would be receiving from referees. But sometimes referees, as you said,
they don't like some things.
Do not help, but they also play a role of a devil. So we need to be careful. And I want to really thank everyone. So Suma, Alka, Reji, and Andrea, who had to leave because of a very exceptional situation he's in, and all of our friends and colleagues who participated, in the discussion and offer comments to Suma. So thank you very much. I think this series of our webinars on research papers will continue, and we will continue to remain engaged with all of you with more interesting research being presented and discussed. So
Nagesh,
with that,
can I just say one more thing?
Sure.
So I just wanted to thank all the people at ISID for making my visit here so comfortable and being so welcoming of me. I'm almost at the end of this period. So I just wanted to extend my thanks and, I hope to come again sometime. Yeah. But please stay in touch.
Well, I had not even realized that this is coming to an end. So, but thank you very much for staying with us, or spending time at ISID, and I'm sure everyone at the faculty enjoyed having you around and benefited from discussions with you. I look forward to you coming and continuing to remain in touch now that we have built partnerships and we have got to know each other. So I hope you would continue to remain in touch and continue to collaborate with some of us at least. And all the very best. To your, other engagements in the country and back home.
Thank you.
All right. So thank you very much, everyone, for joining us today. And I'm sure you enjoyed this discussion as much as I did. Thank you. Bye-bye.
Thank you.
And all the best, Suma.
Thank you.
Thank you.